Hi, everybody. I welcome you to this great session where we talk about something extremely important for most of us. For many of us, this is going to be very beneficial. It's a beautiful evening. Beautiful evening. How are you? Can you give me a comment? Just let me know where you're watching me from and let me know if I'm loud and clear. That is always appreciated. It's always nice to know when I'm loud or when I'm not loud. So it's a beautiful evening. I invite you all to this great session. Let's get into it. Let's do what we have to do for us to get where we need to get. So we talk about something extremely important, and that is funding. So am I clear? Tell me, friends, am I clear? And please share the video with those who care about. Share the video. Share the video, please, so that we can have as many people as we possibly can. All right, so fantastic. So there we go. All right, so we have Sinyama. Sinyama, it's good to see you. Chisi, good evening. It's good to see you. Kindly share the video. Hi, Miriam. It's good to see you. Good evening. All right, it's good to see you. We have Harrison. It's a good evening to you, Harrison. Rosarine, it's good to see you. Good evening. Good evening. It's good evening, everybody. It's good evening. All right, so good to see you, friends. Share the video with those who care about as we discuss this amazing session, which is going to change somebody's life. Fred, it's good to see you. Lakti, hi. It's good evening. It's good evening. All right, keep sharing the video. Let's have as many people as we possibly can. So now, this session is one that speaks to many of us. And the reason why this is going to be extremely important is partly because it is something that we are always encountering in our day-to-day life. We want funding. All right. So, like I did mention earlier, that we are at a point where you feel, you feel that your business is doing fine, your business can grow, but maybe the only thing that is lacking is capital. All right. So you want to have some capital, but every time you apply for funding, the bankers and the people that have got the capital, they keep turning you down. They tell you, no, we are sorry, we can't give you funding. Sometimes it's promising they're about to give you the money, but before you know it, hey, it all goes sideways. So that's what we want to discuss. That's what we want to focus on this beautiful evening. We want to make sure that we understand how debt works. We want to make sure we understand how can you qualify for some funding. What do you do for you to get the funding that you need? So that's what we want to focus on this evening. How do you qualify for funding? So now let's get our ball underway here, friends. Okay, I've shared a sheet with you that we're going to stick with for a very long time this evening. Now, like you've seen the question, it says, I am an SME. How do I qualify for funding? That's the question we want to answer this evening. How do you qualify for funding? Now, before we answer that question, I'm going to take you through something very real, something I did for an SME today. All right, the numbers we are seeing, these are real actual numbers for a real business right now. All right, I did this on a real business today, and this is what we are going to use, and I'm going to show you how you can qualify for funding. But before that, there are some few things that you must understand. You must understand what the bank looks for. How do you qualify for funding? So I'm going to talk about what you need to do before you apply for funding and what you need to know before you apply for funding. And then you need to understand things from the bank's point of view. A lot of people say, you know what, the banks can't give us money because we're SMEs, we have no payslips. It's because most people don't look at things from the bank's point of view. They look at things from a very narrow perspective. So now today we're going to look at the bank's view, all right, so that we can help you qualify for funding. The next time you're going to go to the bank and apply what we're going to discuss this evening, I assure you the situation is going to be extremely very different from the way it has always been. You'll be shocked how things are going to turn out. So before we get into the very point, there are some few statements I want you to first understand. And one of the statements is what we call the time value of money. Time value of money is a very important concept for somebody who wants to get a loan to understand. And the reason why this is important is partly because every bank, all right, every bank and every financial institution, they understand the importance of this. So the core principle in finance and worldwide is called time value of money. Now, this simply means that money today is more valuable than money tomorrow. So the rationale behind is that money that we receive today has a potential earning capacity. It is better to give you 1,000 kwacha today than giving it to you tomorrow. Partly because if we give it to you tomorrow, it may not be able to buy the same things it can buy today. I want you to follow this very much closely. First of all, you have to understand this before you think about applying for funding. Time value of money. All right. Now, this is why every person in the world would want to receive the money right now, unlike giving it to them next year, because they know that money with time is going to lose value. So this is a very, very important concept that you must understand before you apply for money. Now, let's imagine that we have been paid the 1,000 kwacha, and we have been offered to choose whether to receive it today or after 1 year. If we choose to receive the money today, we can go to the nearest bank and deposit it for a year. Right? Given that the bank wants to attract such a deposit, the bank may be willing to pay us some sort of interest, maybe let's say 10% interest, which means by the end of the year, we are going to make something like, 100 kwacha on that 1,000. So that is going to motivate us to put money in the bank. All right? But if somebody gets your money today and they don't pay it to you without interest, that money will lose value. So the only way you can add value to your money is if you charge interest. It's what the bank understands. The bank understands when they give you the loan today, you pay it after 5 years or 10 years. So how do they add value to the money which they give you? So the bank does a number of things. And one of them is they look at the interest rates. Now, interest rates is another thing I want you to understand very well before you even apply for funding. Please, I want you to follow this because it's very, very important. Please follow this one very closely. Time value of money is money losing value with time. So how do you attach value to money? Is if you charge interest. And that is where the problem comes in. Banks charge interest. Village banking, they charge interest. Everywhere you go, they charge interest. All right? So it is the interest rate that determines how much money is going to go into circulation. So the interest rate is the cost of borrowing or the price that you pay for the money that the bank gives you or that the financier gives you to finance your business. So you must understand also that there are different types of interest rates. All right? There's what you call mortgage interest rates for those who want to build houses. There's student loan interest rates. There's interest rates on investment loans, bonds, lots of stuff. So there are all these different kinds of interest rates. So before you apply for any funding or you seek for any funding, understand time value of money, understand interest rates and the types of interest rates. Now, when it comes to interest rates here, there's something I would like you to understand. I would like you to understand the factors that influence the interest rate. So before you go and borrow money, you know the time value of money, they're going to charge you interest. Then you ask yourself a question, okay, fine. What are some of the factors that are going to influence the interest rate? So number one, it is maturity, all right? Number two, it is liquidity premium. Number three, it is default risk. Number four, it is expected inflation. Number five, it is a risk-free rate of return. So you have to understand all these 5 components because these are the main factors that influence interest rates. So you must ensure that this one is you're okay with it. So throughout this session, we will talk about the components that form interest rates and how you can use them to your advantage in your business. All right. It is important, all right, for you to understand this because this enables you to make a very much more informed decision of how much money you're going to apply, which bank you're going to apply to, or is it which source of finance you're going to use, because you've understood interest rates and you've also understood what factors are influencing those particular interest rates. Then you can make a much more better decision on understanding which bank can I go to, which financing house can I go to, because now you know the time value of money, you know the interest rates, the fast rating interest rates, and then you know each bank's interest rate or each source of finance interest rate, right? You must understand that the last one that you see at the risk-free rate, that's what we call the building block of all interest rates, all right? Because an interest rate on the risk-free rate is one that assumes that no risk of default. So you have to understand, if you're going to use a risk-free rate, like for example, government bonds, those are risk-free investments. Even the benefit is very low because there's no doubt. You are guaranteed you're going to get your money at some point. All right, you are guaranteed. The other issue that's going to affect interest rate is also what is called inflation. Inflation is the way money loses value with time. So banks understand that, money is going to be losing value as time goes by. So how do we compensate for this loss? So they are going to incorporate a percentage in the interest rate for inflation. So when you get a loan from the bank or from anybody else, you must understand the interest rate that you pay contains a component of inflation to compensate for that loss, so that by the time you'll be paying that money in the future, the money would have some value. So you must understand why. You must understand this part also. But again, you must also understand when someone borrows a given amount of money, there's always the chance that he or she may not be able to pay back the money. Maybe because of bankruptcy, or because they're unable to pay the money, or because of whatever circumstances. That's why you see that other part there, the liquidity aspect here. The bank looks at that, and also the default risk. They're going to see, okay, what if this person defaults? How much do we stand to lose? All right. So the bank is going to look at all these things. How long do you want a loan for? What is your financial muscle? Your ability to pay back your obligation? What is the default risk? So each client who goes to the bank to get money, the bank creates what is called a personal risk profile, because this one is unique for each individual. You may be getting the same salary. Somebody gets 10,000 kwacha, somebody gets 20,000 kwacha, but you find that somebody gets, you both get 10,000, but you go to the bank, your friend gets how much? 100,000 kwacha loan. You get 10,000, 20,000 kwacha loan. Why? Because you have different default risks. This is a risk that the bank calculates on each individual. For example, they look at your payslip, say, give us your payslip. Let's look at your payslip. Do you owe anybody else? How much is your basic pay? All right. They look at all those things to understand the default risk, but also your financial muscle. So the banks are very much interested in understanding these five things: maturity, liquidity, default risk, expected inflation, and the risk-free rate. So these 5 things are very important. Every bank will look at this before they can give you the money. It is these things that are going to influence the interest you're going to pay on the loan you're going to get. So before you apply for the loan, you have to understand these things and apply them to yourself and see where you're going to fit. Now, I'm going to show you a very, very practical example of how these things are used in practice, so that you understand this before we think about what you can do to get the loan or to get the funding, even though you don't have a payslip. This is extremely important. So now here we are, now we're looking at all these things here. Okay, so we looked at that risk-free rate, we looked at all those kind of things. Now let's go and talk about something even better. So now we've understood this thing. Fine, there's all these 5 things that are influencing the interest rate. So now there's one thing which is very important than all these things here, because as you can see here, the bank, when you go to them, the bank is thinking about something. They want to determine how much are they going to lose if you default. That's one of the key things the bank does. They look at you, they say, okay, fine, if we give this person this loan, how much are we going to lose if this person fails to pay us back our money? The bank calculates that. And then they say, okay, fine, how likely is it for this person to default? Okay, then they look at the situation, then they assess how likely it is for you to default. So these 2 questions are going to determine how much the bank can give you when you apply for funding. Are they going to give you funding or not? Now you are an SME, you don't have a payslip, you have nothing. Still, the bank will do this. They'll do a risk profile, and then they'll ask themselves, how much are we going to lose if we give this person this money? what is the probability of this person defaulting? So now the question is, what does the bank use for them to determine these things? And this is the point you must understand what the bank looks for when they're looking at you, right? The bank does not care whether you have a payslip or don't have a payslip. The banks, they care about one thing. They care about not losing the money, all right? They don't care about a payslip. You can get a loan without a payslip. Somebody with a payslip is too slow to get a loan because the bank cares only about not losing the money. They want the money back with interest, hence the need for them to ask these two questions. So now, like we said earlier, the bank is going to calculate what is called expected loss, right? And then they're also going to calculate the exposure at default. What if you default? How are they exposed to the risk? All right. They're also going to calculate the probability of you defaulting, and then they're going to also find out the loss given default. These are the things the bank does. So you need to understand this, your position, before the bank can start dealing with you. So first of all, look at these things. Oh, okay, fine, this is good. Now, the exposure at default simply means how much of the bank's money will be at risk if you default. So the bank is saying, fine, if this person defaults, fails to pay us the loan, how much money are we going to lose if this person defaults? Oh, okay, if this person defaults, possibly maybe we are going to lose 10,000. Okay, fine. Let's now look at the probability of default. How likely is it that this person is going to default? They work out the probability. Okay, fine. Then they say, okay, fine, let's look at this person. Let's look at the loss given default. The percentage of the bank's money that will be lost if you default, because the bank does not lose all the money when you default. The bank is very clever. In most cases, the banks will only lose up to 30% of their money when you default. They don't lose everything because of a system that I'm going to show you. So they are going to calculate a percentage of the money that is going to be lost when you default. They are looking at you before. So you think you have a house, you have this documentation, but they are refusing to give me the loan. They don't care about your house. They don't care about your collateral. They don't really care about that. So we're going to show what the bank cares for a lot. That determines whether they're going to give you the loan or not. So they're now assessing you. You don't know that these things are happening behind the scenes. So you are waiting. No, they tell you, can you give us this? Can you write this here? Bring this document. You don't know what's happening behind the scenes. So you are waiting. A week later, you discover that you can't qualify. It's because they have done these things, and then they realize, this person, if we give him so much, we're going to do so much. No, this one is a high risk. All right. So now what happens here? Say, so for example, here, all right, the bank is going to say, before I give this money, exposure to default, all right? They say, we'll give this money 500,000 kwacha. If it does not pay back this money, if it defaults, we stand to lose how much? 500,000 kwacha. Okay, fine. So from this 500,000 kwacha, how much of the bank's money are we going to lose? This is what the loss given default. The bank can only lose up to 30% because they have a mechanism in place that helps them not to lose everything they have given you. All right, and we're going to explain that later. So maybe just 30% of this money, the bank is going to lose it. Oh, okay. They say, oh, okay, fine, fantastic. So now, when the bank looks at the amount of money they are, let's look at this person's earnings potential. All right, they're going to look at your earnings potential. How much do you earn? They're going to look at your liquidity, your financial muscle, and then they're going to look at your credit history. Do you have a history? Have you ever bought this amount before? If yes, did you pay back without any problems? This is where people don't have records find it hard to get a loan now, because the bank looking at the records, your history, have you ever defaulted before, and things like that. They also consider other external factors. All right, but because when they give you this 500,000 kwacha, you must repay it with interest. So the bank does this. All right, they assess you. So now there's something that you must do to beat the bank, all right, or to beat anybody who's going to give you a loan. And this is a very, very important aspect. So I want to give you now a practical example here of what you must also do, all right, behind the scenes. Because now, like we said earlier, we said understand interest, understand the value of money, and understand things from the bank's perspective. What the bank are looking at when they're looking at you, what are they looking at? What are they seeing, right, when they're looking at you? Now, you must give the bank, you must give the financier a picture that is real, something that they can look at and say, you know what, let's give this guy a loan. This guy can pay us back our money, right? When we talked about time value of money, I'm going to give you an example. I think I'm gonna run some numbers here for you to just see. I was given an example. If you okay, time value of money simply means the money that is given to you today will be more in the future, or be less in the future because to lose value. I'm going to show you that one, but in the meantime, let me just show you this analysis here. So today I did this analysis, this appraisal for an entrepreneur who sells charcoal, right? So I did this today, actually today, and I feel it's a very good example for us to use for you to see whether this entrepreneur is going to qualify for funding or not, all right? So to understand what the bank is going to look at also, it's also very important. Now, let's look at this entrepreneur. So this lady here, actually she's a lady. This lady here, she wants to get a loan of 100,000. So we're doing this one today, right? Now, here's what she told me. She told me that she buys charcoal from Masaiti. So she goes to Masaiti. That's where she buys a charcoal from. All right, guys. Okay. Are you able to get me clearly? Please give me something in the comment if you can hear me. I think my speakers gave me something. If you can hear me, give me something. So now this is the part to invite your friends, tag your friends, share the video. Let those who care about come through. They need to understand this. So now, friends here, please invite as many people as you can. Share this video. Let people come and know how to do these things. Now this lady told me here, this entrepreneur told me today that, you know what, she goes to Masahiti to buy a charcoal from Masahiti. And now we're doing this one today. Now she tells me that she needs to boost her business. And she wants to get a loan of course 100,000. All right. Now she told me these estimates. When she goes to Masai to get a charcoal, she stays there for 30 days. All right. She stays in the villages. She stays in the lodge, and that lodge she pays 50 kwacha per night. Right. And then also she told me that she buys food for 30 days. So each day she spends 33 kwacha for food. That means she spends that much, right, for food. So she spends that much. So we're just making these rough estimates for you to just to see. And then she tells me when she buys charcoal, the people those that pack charcoal, she pays them at how much? She pays them at 5 kwacha per bag. All right. Now here's the issue. Our capital base is 500,000 kwacha, and this is per year she uses 100,000 kwacha. So in 100,000 kwacha, she's able to buy how many bags of maize, how many bags of charcoal? 2,000 bags of charcoal. As you can see, sales units here. So these are the 2,000 bags of charcoal she buys on 100,000 kwacha. And now each of these 2,000 bags, to pack it, she pays people 5 kwacha each bag to pack. So if you multiply 5 kwacha by 2,000, you're getting that 10,000 kwacha there. That's how come those numbers are coming through. All right. And now she buys an empty bag. She buys it, as she said, she puts this charcoal into 25 kgs because they're easier to carry and stuff like that. Yeah, so she says she buys 25 kgs. She spends 2 kwacha to buy an empty bag. Now for 2,000 bags, that is 2 kwacha times 2,000. That's how you have this 4,000 kwacha here. All right. And she also said that when they are packing charcoal, there's this wrap, this head, we call it in Bemba around that big head, right? So that's what we call a head wrap. So to wrap that thing, she also pays 5 kwacha per bag. So to pack one bag is about 10 kwacha, right? So that's 5 kwacha for the wrap. For 2,000 bags, that's about 10,000 kwacha. And now because she's in the bush, so what she does to get the charcoal, those 2,000 bags from the bush to the roadside, there are people who've got bikers and some people come with these trucks. So she puts at 4 kwacha per bag to transport from the bush to the roadside where she can put on a truck. So those people who have bicycles and those people who've got those small vans, they help her at 4 kwacha per bag. So for 2,000 bags, she spends that one each cycle she goes. Okay. Then she also said to move each bag, one bag from Masahiti to Lusaka, she spends 35 kwacha per bag. These are 25 kg bags, not those big 50 kg bags. She spends about 25 kwacha per bag, which means for 2,000 bags, she spends about 7 about 70,000 kwacha. That's a good amount. Okay, fantastic. Then when she comes to Lusaka, she sells in a market called A1 market in Kabanana. That's where she sells the charcoal from. So offloading that Kabanana market, she pays 5 kwacha per bag to offload, which is about another 10,000 kwacha for 2,000 bags. Now at the market there in the storage, so when you offload, of course, when you offload, there is land and there is also storage. So she said, this 5 kwacha, this 1 kwacha is for security. All right. So you pay a total of 6 kwacha for land and security. Not that somebody will be there to guard, no, just to put your things for the chairman, whoever is in charge, to just know, okay, there's this lady who has come with charcoal. This is a charcoal. So those people who sleep at the market, they can know, okay, fine. So she pays 30 kwacha. All right. She just pays 30 kwacha. It's a one-off payment. That's just how they do it. You don't have to pay every day. So all marketeers just pay 30 kwacha. So those people who sleep there can, take care of these charcoals. So now, when we did this, so I did now make an estimate because she wants a funding of about 500,000 kwacha for 5 years. That's the loan that she wants to get because she estimates that she's going to make that amount there. You can see that's about 1.8 million there. So that's what she did. So I said, okay, fine, this is good. This looks like a lot of money. 1.8 million, charcoal is profitable. Yeah, this is very profitable. So now there's something that we did. All right. So if you look at now these numbers down here, you're going to something that we did. I did not include a tax because being an SME, TOT, let's say she's paying TOT of 4%, and that's the tax amount she's paying. Okay. So now we have the total cash flows. So when we less all these costs from the actual sales, because she's selling 2,000 units of bags, all right, and those 2,000 units, they are going at the selling cost of 180 kwacha per bag. So 180 by 2,000, you get 360,000. All right. If you roll that down by 5 periods, it's going to give you 1.8 million. The 661 is just a forecast. It's not part of the. So hash is going to end in the year number 5. So the 661 is a forecast. I just added to just see how time value of money is working on this project. So now we have the numbers. So what we did now, we did incorporate some accounting rules. We discounted this money. All right. So as she's counting, if she removes all her costs, she's now going to remove how much to herself? 231,080 kwacha. That's a very good amount of money to remain with after everything is paid for. So now, this is where that concept we told you earlier of time value of money makes sense. With time, money loses interest. Money loses value. So this 231,000 kwacha, if she gets it now, well and good. But the problem that this money is not coming today. All right. So now, if we discount this 231, because according to the bank, or maybe just as an example, we had used 29% as the interest rate. That's the rate she's going to use to borrow this money, 29%. Seems very reasonable, 29%. So we discounted these cash flows here, the total cash flows at that discount of 29%. So now we have the present values. So we have incorporated, inflation and stuff like that. So now what we have just included the time value of money. Yeah. So now what we have here, we have the 231 now turning into 279. All right. So we have 231.80. So when we discount at that rate, so we're going to have that figure from the start. Now we have 279.69, right? Then we have 216.33. We have 167. So all these are the cash flows that this lady is going to be having. So if you are observant, you've seen that these monies are reducing in value slowly. As we are going, these monies are reducing in value from 500. Of course, it goes to 27. It goes to 21. It goes to 16. It goes to 13. It goes to 10. And of course, it goes to 7. So you can see that the money is reducing with time because of time value of money. All right. The more time passes, the more money loses its value. So if you look at the number 6, it has even gone down all the way to 7 and stuff like that to show you that with time, money is going to lose some value. So now we've done this. So now we have seen, look, fine, these are the cash flows, and we've included a discount factor of how much, of 29%. So these are the cash flows. So now what do? Let's find out if it's okay for this woman to go and borrow 500,000. So what did we do? We worked at something called the NPV and the internal rate of return. So if you look at the NPV, she has a positive NPV there, right? Which is a good thing. That's a good thing. It means if she invested in this business today, she's going to be worth by that amount. That's a very good thing. So every shareholder, every investor wants to see that. They want to see, before they can give you the money, they want to make sure that your project has a positive NPV. That's what every investor in this world looks for. They don't care how big your house is, how beautiful your house is. They don't care what land you have. They care about the NPV. All right? They care about the NPV. So you can see the NPV is about 391, a positive NPV. That's a good thing for investors, because now they know if they give you the monies, you can pay back. All right? You're going to be wealthy by that amount. So the only problem that we found with this lady's business, when we did the internal rate of return, this statement here, the internal rate of return, simply means the rate at which you will not make any profit. That's the IRR. The internal rate of return is the rate at which your NPV is going to turn into 0. What that means in simple terms, it means if you are going to borrow money for this project, you should not borrow at any interest higher than 30.9%, because any interest higher than 30.9% will result into you making what? In you making a loss. So the internal rate of return is 30.9, the rate at which NPV is equal to 0. So this means this lady, she cannot borrow money at a rate higher than 30% because she'll make losses. So now this is what the problem was. All right, like I was saying, the bank now let's go back to the bank. The bank is looking at you here. They are saying, what is the default risk? Let's estimate the default risk. All right, they are looking at what is the probability of you defaulting. This is what the bank now is looking at when they look at you. So they say, let's now work out the probability of you defaulting. So the bank is looking at you here. Now, what the bank can simply do is a very simple thing. For example, even you can see now from here, look at these numbers here. Have you noticed that the difference between the rate at which the NP will be 0 and the borrowing rate is simply 1.9%? She's borrowing at 29%. A benefit for this whole project for this is just about 1.9%. Now that's risky. So the banks are going to look at your business and say, okay, fine, okay, this person is going to the IR is about 30.9%. If let's say she's spending 33 kwacha per day on food, if she only spent about 50 kwacha on food, that, friends, changes a lot of things. Have you seen? That means now the figures have gone to 1.5, which means now even the benefit is now going to change. So the bank are looking at that. So we are going to perform something called sensitivity analysis to analyze your cost. Okay, from the costs that you have here, which one among these costs, if it was increased even by just 2%, can result into you making losses? So this lady, her business is good. It shows a very good amount of money. You know, if you're not doing this, you say, yes, it's good. She's going to make 27,000 in the first run, and then 21. This is good money. But if you look at the sensitivity of our variables, which one among these ones, if it was just increased by 1 kwacha, is going to change? Now, let's imagine today this is year 1, okay? And now next year she goes back to buy this charcoal. The people who pack say, no, you give me 10 kwacha. That means she's in trouble here. So your interest rate should not be too close to your internal rate of return, because any strike mistake here, it means this one is going to turn into a negative rate of return. You begin to make losses. Now, where the problem is here, if you think about it, what the problem is, the bank at this point, they don't care whether you make losses. For example, if let's say you've gotten a loan, all right? When you've gotten a loan, let's say now, let's go back to the loan sheet. When you've gotten a loan, for example, here, she's gotten a loan of about 500,000 kwacha here, right? And that loan is at 29% interest rate. So the bank is counting the interest rate. They're saying, okay, fine, we've given her the loan for 5 years. That's about 60 months. After 60 months, you're going to pay the bank total of how much? Of 952,256.1. That's the total amount of money you pay, almost double. All right, that's the amount of money you're going to pay in 5 years' time. That's the amount of money you're going to pay in 5 years' time. All right, so every month you're going to be paying, say, 15,870. So now the bank is looking at you and then they're saying, okay, fine, this person, they can manage to pay 15,870 as things stand. But the problem is, if there was just a slight change in any of these variables, this person will not be able to pay us that amount of money. So what do we stand to lose? So now the bank is now looking at you, all right, the default risk, the probability of you defaulting. They're asking themselves this question: how likely is that this person will default? Now they rate it, say, it is very likely this person can default. Now, once it is ascertained that it is very likely for you to default, the bank will be very reluctant into giving you a loan because now they are scared. All right, the bank is now scared. They're saying, we can't give this person a loan. Guys, please share this video with somebody. Please, let's help as many people as we can. Share the video. Let's get into some of the best things we can do here. So now, for now, we're still looking at you and the bank. So now you're trying to understand your business and what the bank is looking at when they're looking at you. All right. So now the bank says, okay, fine. The chance of this person defaulting is quite high. All right, because their rate of return, their IRR is too close to the cost of capital. That's the problem. So the bank already is scared of that. They don't want that. No matter how many buildings you have, they won't give you the money because they don't want to lose their money. Now, notice something here. All right. If you look at this lady here, if she gets that loan, look at the loan amount. The loan amount in 5 years' time total is about 952,256. 952,252 kwacha, 252 1 kwacha, 0.1 whatever that is. So this is what you're going to pay after 5 years. As you can see, your loan now is 0 after 5 years. It has been liquidated. So now let's compare the total loan after 5 years. This lady got a loan. She says she gets that 500,000 kwacha. After 5 years, she's paying 15,870 every month, and that interest is going up, and the principal and stuff like that, residual debt. So now in 5 years' time, she's going to pay this amount of money. So let's compare this amount of money with the total money she can get if she sold all her charcoal with that particular investment. So now let's go to our charcoal here. So we come back now here. Now the PV of cash flows. Now a smart investor will not, a smart salesperson will not count these as money. So what people do, they say 180 times 2,360 times 580, 1.8 million. That's fantastic. No, there's time value of money. So we have to discount those cash flows to bring them to their present terms. All right. Now these are the amounts. So if we get the total of this one here, all these cash flows from 27 all the way to 78, you're going to see this lady is going to have something like 971,998.76. That is the total cash flows she's going to get from this project. That will be the total cash flows. But remember, how much is her loan? Her loan is this amount here, the 952,256. So I imported that number and I brought it here. That's the loan amount. So if you compare the loan amount that she's going to pay the bank, and you compare how much money she's going to make from the bank, she's going to make from the business, she has a gain on this investment of 19,742.65. Well and good. So for now, she's in green. So imagine borrowing 500,000 kwacha, and then you make 971,999. Then you end up paying 952 out of so much hard work. Then you remain with how much? With 19,742. Now remember, these monies, they're not coming in the first year. This is money for the five cycle periods. So for now, you say, okay, fine, there's some profit. So now, less informed business people, they are going to go ahead and say, what? Wow, there's a profit here. But let's say she buys those charcoals, all right? She's selling at 180. She comes to Lusaka and then she discovers that actually the selling price has been reduced because on the market, too many people have got charcoal. Now, every bag of charcoal is going at 160. Just simple 160. Look at the change. Have you seen? Simple 160 changes everything. Internal rate of return goes to 24.2%, which means she cannot borrow any loan above this rate. Now, the problem that we have, she's already bought a loan at how much? At 29%, which means this lady will make a lot of losses, but because there's no gain. Now, here what she's going to have now here, she's going to have a loss of how much? Of 88,257 kwacha, 21 ngwe. Now, she has a loan. The bank does not care. Or whoever finance does not care that, you know what, the prices have changed. No, for them, if you look at your loan, they are still deducting you 15,870.9 every month. They expect that money from you every single month. All right. But the problem is that you can't afford to pay that money because now the prices of goods and services have changed. The prices are now 160. So there's a problem. So you can see why we are saying the bank is looking at you. They are saying to find what is the chance of this person defaulting before we give him our money. Let's look at the chance that he can default. They look at the probability. They ask themselves these two questions here. How much are we going to lose if this person defaults? How likely is it that this person is going to default? So now they work out these things here to just as a 10 whether you're going to default or not. So the bank does that. Now they consider your earnings potential, liquidity, credit history, external factors. They consider all these things, and then they see if the prices were to be increased. These are external factors were to be reduced by just 20 kwacha. This person can't afford to pay the loan. In that case, the bank says we can't give you the loan. Do you know why? Because they've looked at the external factors. If the price goes down by just 20 kwacha, you are in debt of 88,000. You can't afford to pay. That means there will be no profit to you. So the internal rate of return helps you to understand that at this interest rate of borrowing, your NPV will be zero. You will not make any money, which means for this lady to borrow money, she has to look for a source of finance which can give her a loan at a rate, say, of maybe 15% or maybe 20%. So maybe she needs to go and look for somebody who can give her the loan at 20%, something lower than 24, so she can have some difference. Now, if she goes to 24%, look at the money. She's going to have a gain of about how much? 111,000. Now that changes everything. That small 4% pushes this lady up. And now the bank will say, you know what? We can give this guy a loan. Because they are looking at the change there, the gain after everything. The financiers are looking at the gain after everything. Okay, fine, okay, we can help this person. Now here in this issue, what we have 29. Now let's say, what if the price does not change? Let's say the price remains the same, remains 180. All right. Let's say the price remains 180. Now, there are sometimes some people, this is why this is important for you to understand before you apply for a loan. What if you gave someone a discount instead of just 5 kwacha? From 180 to 5 kwacha, 175 price. Have you seen? Just a discount of 5 kwacha is making you owe 7,257. Because while you're giving discounts to your clients, the bank does not care about your discounts. Your loan is being deducted at how much? 15,870. And the bank does not give you discount. When you get the loan, if anything, sometimes they revise and they add a small percentage again. It happens sometimes. So this is why it's important that you understand this before you can begin to look for funding. You also have to know how much of the discount can I give somebody? How much is the maximum? So that you work these things out before you go to the bank or before you go to anybody to look for funding. You've done this analysis already. You know all the angles. So now let's say you say, okay, fine, I'm not going to give somebody a discount of 5 kwacha. What if you gave a discount of just 3 kwacha? As an example, 176, for example, all right? Still, you're owing. So the best discount that you can give, maybe let's go to 178. At 178, yes. If you just give somebody a discount of 2 kwacha, look at how much your money is reducing. From 29 to 8,000. Just 2 kwacha is going to affect your money by a big margin. Now, a lot of business people don't understand the effect of discounts on their income in the long run. They just say 2 kwacha is a small amount of money, just 2 kwacha. Who cares about 2 kwacha? It's just 5 kwacha. But if you keep giving those discounts, remember you have 2,000 bags, and to give 2 kwacha on just 1 bag, that's a lot of money in the long run. And it costs you a huge chunk of your amount. Just that small amount. And you can see your internal rate of return has now even reduced from 30.9 to 30.3, which now increases the risk, because the bank says the only difference between the cost of the interest rate and the rate at which you're going to make no money is just 1.3%. So you are still a risk. They can't give you the money. Excuse me. You are still a risk in the eyes of the bank. So the question is, so now what do you do? All right? What do you do? Because now all these things are showing you from the outside. No, this is the problem. This is why it's important to understand how much discount can you give somebody. When you're going to apply for funding, what is the bank looking at? The bank, they care so much. They don't care about what they care so much about this line here, the cash flows. The bank cares about the cash flows more than anything else. You can have tractors, whatever it is, they don't care about your houses. Do you know why? Because the banks hate selling people's houses. It is costly. They're going to incur advertising fees. They're going to spend a lot of time going to court. Sometimes it takes even years before the house can actually be sold, before the court can pass a ruling. So the bank hates collateral. So when you say, I don't get the money from the bank because I have no collateral, then I have no payslip, no, that's not the problem. The reason why you don't get money from the bank is because you have no cash flows here. The bank is looking at your cash flows. Will this cash will be able to pay back the loan? So you can see. Now, imagine that you give a discount of just 4 kwacha or 5 kwacha, whatever it is. Your cash flows are being affected. Now, so you as a business, you can say, fine. So for me to be on the safe side, what can I do? What if you sold your charcoal at 200 kwacha? Now, just a small increment, you can see, it changes the whole scenario. Look at your IR goes to 37.5%. Now, at this point, the bank says, okay, fine, the rate is 29%, and the internal returns is about how much? 37.5%. Okay, fine. The difference about 8.5. Okay, that's not so bad. But again, they are saying this too is a risk. They're going to say, okay, for how much can you give this one? Maybe let's give this person maybe 200,000, maybe 50,000. Looking at the levels of risk we are exposed to. So you must understand your cash flows. Put them in writing very well before you go to the bank, because the bank are going to assess your cash flows. If your cash flows, one bag of charcoal is 400 to give you money. Look at your cash flows. Your cash flows are 620, 483. Look at it. You have 2-point-something million. So the bank knows if they gave you that 500,000 kwacha, in 5 years' time, you're going to pay them 952. And look at how much you're going to remain with. 120 to yourself. You're going to make about 2-point-something. So they're going to give you the money because already they've seen your cash flows are healthy. Have you seen? Your cash flows are okay. So they're now, every bank will be rushing to come. And now look at your NP, your IRR. Your internal returns about 101.1%. Who wouldn't want to give you debt? Every bank in this world will be running to your doors to come and give you a debt because they know you can pay back the money. Banks want to give money to people able to pay back with interest without default. So when they look at your IRR, they say, okay, fine, oh, this one can pay us back. They will run to your doorstep. They come and give you the money because they've seen what you can do. So the problem that comes in for most people is that they have no this. Look at what the bank is looking at here. They're looking at this thing here. They are saying, what is your earnings potential? That cash flows there, liquidity connected to cash flow, your history connected to cash flow. When you are selling things as a business, as an SME, do you write something somewhere? If you don't keep records, I can assure you it will be 17 times harder for you to get any funding from anybody. Not even your neighbor will give you the money because you have no records. So start small, all right? As an SME, buy books, all right? I have manual books myself, and of course, I have hardcover books. I have soft copies for my receipts. Every single transaction that you sell, record it. And have the habit of depositing money in the bank. So that when the bank says, can you look at your earnings potential? Can you look at your history? They are going to look at your bank statement, and then they're going to see, okay, fine, this person's got sales of so much in December, January so much, last year November so much. Oh, this guy can pay us, because these are the actual monies that go in the bank. Banks trust banks. If you are putting money, a lot of money here to maybe here to money, whatever it is, banks don't really care so much. They trust banks, because banks show exactly how long your money stayed in that account, where the money came from. So there's that paper trail. They can look at your financials from the bank's perspective. So the banks trust banks. Make it a habit to be depositing all your business monies in your business bank account. Register your business, open the bank account, start recording everything. Even if it's 1 quarter, record it. It will make a difference when that time comes for you to look for funding, because they're going to look at your record, your history, and say, from the past 6 months, how has this person performed in this business? From the past 6 months, he's made so much money, so much money, so much money, so much money. Ah, this guy can pay us this loan. The banks care so much about cash flows. Don't care about collateral. They hate collaterals. They love cash flows, because selling your house is just too involving for the bank. They are busy people. They don't want to be spending money going into courts of laws, explaining things, arguing with it. They don't want to do that. Banks love people that keep records. So every single amount of money to make, take it. Guys, tell me if you are following what's happening. Tell me how you are finding this information. All right. Please give me in the comments. Tell me if this is helping you in any way. Let me know how you find this information. I need to know if this information is helping you. Let me know. All right. Let me know how you find this information. So, given the fact that we have now seen that banks love dealing with banks, all right, they love dealing with, so they trust banks. If you want to qualify for funding in the future, I promise you, if you go to Pakra tomorrow, just go on the Pakra portal, open an account with Pakra, register your business, open a bank account. If you need help, I can help you do that. Open a bank account. Every single sale you make, every money in the Airtel money. This is why I love my bank. My bank has a provision where if I have money in my Airtel account, I simply do a transfer from my Airtel money account to my bank. I do that. It's easier that way. Even if you have Airtel money in Airtel money, transfer that money to every money that you have in your life. Let's go in the bank, so that you can improve the credibility of your bank statement. Even if money comes that you want to spend today, that somebody has paid you, let it go into the bank, then you can withdraw it, because your bank statement will show that you received 100,000 kwacha. It came into your account from business money. That improves what? Your credit worthiness. Whatever money comes in your life, let's go to the bank. You don't need to have collateral. If you have a stronger bank statement, every bank in the world will give you the loan. They'll give, every investor will fund you, because they know you can deliver. The other issue is this. So when you are trading, make it a habit of writing things. All right, write things. Like we are saying here, every money, put money in the bank. All right, bank your cash. Right, so here you're supposed to bank your cash. All the time, bank your cash. Apart from banking your cash, you want to do what? You want to maintain your books. All right, maintain books. What does that mean? You're supposed to be putting a record of everything that you do, receipts and payment, every expense. If you bought in Shima, whatever it is, maintain your books. Now, maintaining your books also means that, can you give some respect to your books? Do you have a house? Do you have a plot that you bought? If you bought a house and you're using it for business, so you bought land, can you get the value of that land and put it on your SFP? Put in your statement so that it can attach some value to the statement. Even if you have a house, attach that. Don't tell the bank, not I have collateral. No, don't care. You show them that your company owns some assets. And if you live in your own house, can you convert that house into a business house, so that on the SFP, you can put your house. You have a house that you're using as an office, all right? So that is part of your assets. So if let's say your house is worth 100,000, just imagine, or maybe it's 200 or whatever it is. Then you have land. Land appreciates every year. Maybe land about maybe 60,000, whatever it is, 67, whatever you have. These things already they've given you some credibility. Include whatever you own. Do you have computers that you use? Those are your assets. Include them. Do you have any computers? Yes, you have. Can you include computers and stuff like that? Do you have any laptops? Do you have any printers? Can you include your print? All those are your business. What? Those are your business assets. Do not overlook the values, because if you combine these things, computer, printer, house, land, you know these furnitures. Do you have some furnitures? Yes, you have. Can you include your furnitures? Because all these things, when you put their values together, the bank won't even need to waste time to give you a loan, because they can look at what you have. Do you have furnitures? Do you have printers? I have a printer in my office. All right. This is my business asset. I bought this from GAM. It's a business asset. So this is on my what? On my balance sheet. I own a printer. It's on my balance sheet. So I print stuff here. It's on my balance sheet. All these things, the furnitures I have, all these things like the boards and everything I have, all these routers, laptops, everything, these things are on my balance sheet. Whatever land I've acquired is on my balance sheet. Whatever thing I have bought for my business is on my balance sheet. So my balance sheet looks pretty fantastic. If I go to the bank, they'll look at my balance sheet, and then they look at my cash flow. They're going to say, wow, we have some guy to give our money. So while you have all these small things, if you put them together, they make a lot of sense. Imagine you have computers, maybe you have laptops, even 4 laptops, and laptops are expensive. Some laptops are 21,000, some laptops are 45,000, some laptops are 16,000, 10,000. Those are good amounts to give you some credibility. All right. You have a printer, maybe it's about maybe 3,000 or 5,000, whatever it is. You put that 3,000 there. You have furniture, maybe these desks. If you have 2 desks, whatever it is, and these seats. All right, so you multiply. If you have 2,828 plus a desk of 4,800, you put them together, you find that you're going to have something close to about how much? Close to about 10,000. All these are improving the value of your balance sheet. So you have some assets. You have furniture with 10,000. You have a printer with 3,000. You have computers with 21,000. Whatever. If you have 2, you have 3, whatever it is. You have a house at 100,000. You have land that you bought. There's nothing there. Even if there's nothing, it is your asset put on the balance sheet. 60,000, right? And then you've been trading throughout the year, all right? You've been trading throughout the year. So now you've been showing the bank your what? Your cash flow. Now here are your cash flows. So when the banks look, the bank or the funder is going to look at all these factors. They'll say, you know what? We have a guy that we can help. We have a guy that we can help. Now, here's the other issue that you must understand, friends. Guys, tell me if this information is making sense to you. All right? Tell me. Now, there's one thing that you must also understand. Now, let me bring this one to you right now. Understanding the interest, how interest rate works, gives you some bargaining power. So let's say you're going to the bank to meet up with the bank manager. You want to get a 500,000 kwacha now. So you, from your end, you've already worked out things. You've said, okay, fine. My price here is at how much? Is at 180. All right. So now you've seen that, okay, your internal rate of return is 30.9%, which means you cannot borrow at any rate higher than 30.9% because you make losses. So when you go to the bank, you find that the bank has what? Has 29% interest rate. Remember, even them when they're giving you a loan, banks are very flexible. People are scared of banks. Those are nice people who work in the banks. Talk to them, explain the situation. Now, you go to the bank, you do this. You're going to say, okay, fine, because the bank are look at that maturity premium, liquidity, default risk, expected inflation, and risk-free rate. These are the things that make up interest. These are the components of interest, the factors affecting interest. So now you're going to say, okay, fine. So if you're going to borrow in the long term, the interest is going to be different. So you're going to ask the bank, okay, fine, if I borrow for 10 years, how much will be my interest rate? What you're trying to understand is to get at a rate lower than 30% by a big margin. So the circle fund, if we make it 5 years, we are going to pay so much. If we make it 2.2 years, we are going to pay so much. If we make it 3 years, we are going to pay so much. Let's say you want to make it 3 years, all right? You want to make this one maybe in 3 years' time, or maybe 2 years' time, or whatever it is. The bank can say, okay, fine, what we are going to do now, we are simply going to charge you 15% interest, or maybe 20% interest. Now imagine you get this amount. If you get this amount at a lower rate, let's say you get at 24% interest, right? Maybe just even 25% or 24% of interest. Look at that. Look at the amount of money. It changes drastically. All right. That means in the next period, you're going to pay less than 100,000 to the bank when you're going to liquidate the loan. Now imagine you've understood what you're working with. You know your numbers, you know your IR, so you're trying to look for a source of finance which can give you a loan lower by 30.9% by a big margin. So you begin to negotiate now with the financiers. No, I can afford this interest rate. How about this? Even them, they are people, they are willing to negotiate with you. Now imagine you're a good negotiator. They say they give you this debt at say 20%. All right, 20%. You know what that means? You'll be paying 13,246 every month. In 5 years' time, you're going to pay, of course, 79,481, 7794, 816. That's a very good amount. If you compare now with how much you're going to have, look at that. You're going to have 177, 182. That works for. So that's a simple decrease in interest rate. Benefits you more. Look at you again. It has moved from 29%, 29.7 to 177,000, just 4% of reduction from your loan. So you have to be willing to negotiate for a better interest rate. If the bank was just to give you a small deduction from your interest rate, you're going to see that even your gain goes up drastically at almost the same time. Why? Because you've understood your business, you know the numbers you're working with. All right, then you know, okay, fine, the better rate for me is supposed to be how much? It's supposed to be this one. So if you got this one at 20%, you're even going to see your IR is going to increase. Look at that. 20% means your IR goes to 40.7%. All right, which gives you a gain of how much? Or 40.440 something. So it's a very good investment, a very good amount you're going to benefit. Now you can say, let me go and borrow from the bank. So even you, before you borrow, you have to understand your risks. Because even if the bank gave you the money and you fail to deliver, it's still going to be stressed. So when the bank refuses to give you the money, they're helping you. They don't want you to commit suicide. They don't want you to be depressed. They're helping you that, no, you're not ready for now. Can you go and organize yourself? Then you can come back later. So a good businessman wants to get a loan, first organizes their business. You understand your business inside out. You put all your costs in order. You have your record, your cash flow and everything. Then you go to the bank. Every bank will hug you. Have you ever been to a bank's manager's office before you leave? They hug you. They even say, can I make you some tea? Because they know that you have a client who can pay us some interest. So it must be a win-win situation. So you can leverage a loan to benefit yourself. Let me give you an example. Loans are not necessarily bad. Loans are actually very good. You can use a loan to benefit yourself a lot. All right? You can use a loan. So imagine that you want to make an investment here. All right? So now let's say you need 500,000 kwacha here. You can now make a decision either to use your money to invest or to use other people's money to invest. So let me give you this practical example to see what I'm talking about here, so that you can see how now debt can benefit you like big time. All right. So now let's say now you want to borrow from the bank. All right. You want to borrow from the bank. Let's say you want to borrow. Let's say you need that 500,000. You need to borrow from the bank. You need that 500,000 to make some money for yourself. So you can either get that 500,000 kwacha and use it yourself and pay it yourself, or you can go and borrow from someone else. Now here's the beauty. Imagine that from this 500,000 kwacha, let's say this 500,000 kwacha which you have here, all right? You have this 500,000 kwacha here. Let's say out of this money, you say 10,000 kwacha, 100,000 kwacha from this one is coming from your pocket. You're the owner of the business. And then 400,000 kwacha is coming from the bank. right? That's the issue. Or you can invest the whole 500,000. So let's compare the two people here. So you have person one and person two. Person one says, okay, fine, I'm going to invest only 500,000 quarter of my money, all of it. Person two says, okay, fine, for me, I'm just going to invest, say, 100,000 quarter of my money, and then 400,000 was going to be debt. So this one is equity, for example, that's equity, and then this one is debt. So you are trying to say how debt can benefit you. Now this other guy has put all equity. So this other guy has financed his business along with his money. So as a smart business person, you have to know when to use your money and when to use other people's money. So this person says, okay, fine, I need 500,000 kwacha. I can use all of it, or I can borrow. So say I'm going to borrow 400 and use 100. This one says, okay, fine, I'm going to use all what? All 500. Now let's say these people from the bank, this one pays interest of how much? This one pays interest of 10%. All right, pays interest of 10%. All right, which simply gives him how much? 40,000, which leaves him with how much? 360. Okay, fantastic. Now let's say this company makes a profit, say, of 1 million, right? Do you know what's going to happen? A profit of 1 million is going to mean that we are going to get this other guy who put how much? Who put in 500,000 kwacha, all right, and say we divide the 500 by the 1 million. So it's okay, fine, 500, let's divide by the 1 million. So we can do something like this. We can say the 500, this one, all right, and then we can divide that guy by this guy. So you can see this one makes something of that amount, about 50% profit. On the other hand, this is the ROI, the return on investment. This one makes about 50%. Look at this other guy who used only 100,000 of his money. So you're going to say from his money, he used 100,000 of his money. He has paid interest of 40,000. And then you're going to sacrifice from this 1,000 kwacha here, all right, which you have made here. You have paid debt of 40,000 kwacha, all right, which leaves with about how much? With about 960,000 kwacha. If you divide that by the 100, you're going to see that the return on investment for this other guy is going to be quite a lot, because this one has not used his money. The only money which he used was 100,000 kwacha which he invested. All right. The other money he used was for other people, meaning that this other guy, if you did if you say, let's say you say we get this one and then we divide this one by 960. After we remove that interest, you're going to see this one has almost 100% interest rate, return on investment, almost 100%. Do you know why? Because the other guy did not use his money. This other guy has got 50% because he used his money. This other guy has almost 100% because he did not use his money. So sometimes other people's money can benefit you. So you have to know as a business person, when do you go and borrow your money and when do you go and use other people's money? If you've seen the opportunity in the environment is quite high, all right, and then you know you don't have enough money, that's when you can now use other people's money, because that's going to benefit you more. So sometimes you have to learn how to leverage debt. But unfortunately for today, I'm not going to go into details of that one. So for now, I would just like to just wind up with this one. And I just want to conclude by saying I really hope that this session has really helped somebody to see what you need to understand before you go and get a loan from the bank. Because if you don't understand these things, it will be twice as hard for you to make it. It will be twice as hard, friends. Banks are very flexible. They're not difficult if you just follow them very well. And I hope that this session helps you tonight. If there's any question, I have less than 5 minutes. Let's finish at 22:20 or 22:70, something like that. If there's any question, any contribution, tell me in the comments what are your takeaways as you're going home. All right. What must you do for you to qualify for an investment, for your funding. You tell me what you think you must do. From what we've explained tonight, tell me your takeaway. What must you do for you to qualify? Is there anybody who wants to tell me something? I'll be very much happy to hear from you. Tell me what you must do for you to qualify for funding. Tell me, friends, what must you do? We have 4 minutes to go. Tell me what you must do. All right. So what we have, using the people's money to invest is not good because the interest will be small. So using other people's money sometimes gives you more interest. All right. Because you find that the return on investment is going to be higher than someone else. Like I was giving an example of this guy who puts in, someone puts in 20, someone puts in, someone puts in 100, someone puts in 500. The one who puts in 100, we are working out the return on that 100. All right, so it's a very high interest rate. So sometimes other people's money benefits you more. So you have to know how to leverage other people's money. Every money you have should be put in the bank. Yes, that's a good one. So every money you have, make sure every money you have is put in the bank account for you to understand. So, friends, if there's anything that you'd like to tell me as we conclude, we have 3 minutes to go. I'll be happy to hear from you. If there's any contribution, that will be quite fantastic for me to know. Right? Tell me your takeaways. What are you going home with? Tell me your takeaways. Deposit your money in the banks. Also record every single record every single transaction. Bank trust other banks. That's the fact. Yeah. So you can banks cares more about cash flows than collateral. Yes, they care more about cash flow than collateral. They care about cash flow, not collateral. Collateral is stressful for the banks. They don't have time to be dealing with you going to court. They don't have time. Spending money on lawyers, they don't have that time. All right. That's why they need cash flows. They need a statement that is worthy of being given some money. So I hope that tonight's session has helped you to understand a few things that you must be able to do, what to include in the statement. On a better day, under normal circumstances, I'll be very much happy to come back and talk about this thing in more details. I have not exhausted everything under my analysis. I've just done something simple for our friends to just follow through. But if you want to know more, you want to analyze your investment, feel free to come through to my office, or we can have an appointment. Book an appointment on my page. There's a feature for book. You can book an appointment, and then from there we can take it up, and we can be able to, to help you assess your investment and stuff like that. So guys, there are so many comments. I'm unable to read all of them, but I'll be happy to get some feedback from you. Tell me what is your take home. I have 2 minutes. Using other people's money to invest is not good because interest will be small. Yeah, sometimes interest may be small. Like I said, you have to know when other people's money is good, because sometimes other people's money can give you more interest. Like I was saying here, let me give you this example here, right? Let me give you this example. When other people's money can benefit, let me give you this example. Look at it this way. Let's say, all right, let's say this person invests in equity of his money. This guy uses his money, let's say 15 million of his money. All right, that's just an example. And then what does it do? We have this guy who has used 15 million of his money. Like I showed you here, this guy goes to use 15 million of his money. All right. And then this other guy, what does he do? The other guy just says 15 million of his money. And then the other guy uses how much of his money? He says, okay, fine, I'm going to use only 5 million of his money. So the other guy goes and uses 5 of his money. And then he borrows how much? Borrows 10. If they make a profit, say, of 3 million, what is going to happen? Guys, I'm scattered everyone on this sheet for now. A profit of 3 million will change everything. Look at that. If you get that 3 million, you say on person A, you're going to say that 3 million, all right? And then you divide by the 15 million which this guy invested. You're going to find that. Oh, okay. You divide by you get that. You say that it's go to the 3 million. You divide by the 15. All right, it's going to give you 20% return. That means this guy who put in 15 million in the business of his own money is making on his investment 20%. Look at this other guy. He put in 5 of his money. He borrowed 10. And this other guy, let's say, is paying interest of, say, maybe 1 million interest or 10% interest. All right. 10% means it's going to be paying of how much in interest? 1 million. Do you know what this guy is going to have? This other guy, his return on investment is going to be something like this. We're going to get the 2 million, because from the profit of 3 million, oh, come on now. From the profit of 3 million, we are going to remove the 1 million interest, which means going to have 2 million as money. So we are going to say 2 million, and then you divide this one by how much? You divide that 2 million by, of course, how much? By the money which he put in. His own money was how much? Was 5 million. If you look at that one, this guys make about 40% of return. Have you seen? 40% return on investment. This one who used all his money is making 20%. This one who used debt and his money is making 40%. Same investment. Why? Because this other guy only spent 5 million of his money. Have you seen? This other guy spent 15 million of his money. He makes 3 million. This one just spends 5, borrows 10 at 10%. He makes 3 million, pays interest, return on investment 40%. Right? 40% return on investment. 40%. I think this is the part that I needed to, this is the part I needed to do on these ones. Yeah, this one was getting 100. This one was getting 50%. This one was getting 100 on Roy. I think I made a mistake area. Okay, fantastic. Yeah, something like that. So you can see sometimes other people's money can benefit you more. So this guy makes more money by using other people's money. He makes 100 profit, so he makes 50%. 40%, so it makes 20%. So sometimes other people's money can benefit you. So you have to know when to use other people's money and when to use your money. That's a discussion for another day. All right. So I hope that this session has been helpful, and I hope that you're going to tell your friends about it and stuff like that. What is this one saying? Thought I was learning to Robert Kiyosaki. Well, that's a compliment. Thanks a lot, my friend Harrison. It's good to see you. Mary says every money you have should be put in the bank for record. Yes, that's important. It has really helped. Thanks. Okay, fantastic. This session has helped you. It's good to know. I'm always happy when you guys, that's wonderful news. Oh, fantastic. Keeping records. Yeah, we go with keeping records. Record is important if you want to get money. I must have good record keeping, deposit every cash in the business account. That's exactly what you must do. Movita, that's exactly. Okay, Miriam, fantastic. All right, guys. Okay, good. So, guys, thank you very much. I'm unable to, there are lots of comments. I'm unable to read all the comments, but, oh, someone says the volume is super. Oh, fantastic. I'm happy. I'm encouraged. Yeah, all right, guys. Thank you very much. Thank you very much. We have to end here now. This has been a long session. I am very blessed to have an audience like you, very constructive. Thanks for making me understand I was behind on the same using iPods, man. Oh, fantastic. Yeah, I think we've clarified. Fantastic. Thank you very much. I think I made a mistake that I did. Yeah. I did swap the one to divide with. All right. Okay, fantastic. Okay. All right. Thank you, guys. I did appreciate you. So as I conclude, let me show you this, guys. I'm officially a certified financial analyst. This is why you now see on my name, there is Shadrick CA. All right. The Shadrick CA, because now I'm officially a certified financial analyst. So you're going to come through. And I hope that my presentation tonight has helped you to see that indeed a certified financial analyst. I hope I've not disappointed you. All right. So I'm very excited. I got my certificate yesterday. Program. So I got it somewhere around midnight and I posted on the page and stuff like that. So you're going to be seeing Shadrick CA and FA. FA is for financial analyst, all right, for chartered accountant. So now you're going to be seeing those things. Yeah, so I'm very happy, and I hope that my presentation tonight has proven that indeed I am a certified financial analyst. Okay, Yeah, thank you very much, friends. May God bless you. May God fulfill you. May you find love, peace, and joy. The question still remains, I am broke. I am an SME. All right, that's the question that we're answering. I am an SME. What can I do to qualify for funding? I hope that we have answered you, and I hope that this has been helpful. Have a fantastic night. May God bless you. May God fulfill you. I'm going to see you tomorrow, and I'm going to say bye. See you tomorrow. Have a good night.